And welcome, it's Mick Holly back with my live show, Grow Your Business by the Numbers, where I help you grow your revenues, amplify your profits, and deliver predictable and healthy cash flows within your business. I'm very excited about today's show, where we're going to be talking about how to understand your numbers, how to interrogate your numbers, so that you can grow your business successfully, so you can make a lot of money and build a wealth producing asset. And understanding those numbers is sometimes very challenging for people, and they do it maybe on a quarterly or annual basis, and sometimes are a little surprised when their CPA takes them through their numbers and they get some unexpected surprises in cash flow or profitability. If you're watching this video on my YouTube channel, welcome. There are plenty of others, and if you need help from me, or if you have questions that you weren't able to ask because this is a live session, then please reach out to me and I'll give you some contact information at the end. All right, so let's take a look at where we're going to go. Let's get going, and if you have questions, then pop them in the chat, and I'll try and answer those. All right, let's get started. So, what I wanted to do first of all is give you some information. Why are the numbers important? And so let's just take a look at some of these points that I've pulled out for you. Look, any successful business got to do three things. Number one, it needs to make money. Number two, it needs to generate the lifeblood, cash and cash flow. And thirdly, you want it to grow wealth. You want it to be an asset that continues to provide, and it may be saleable at some point, or you may want to hand it on, but it will continue to generate wealth for you in the long term. And often we're so preoccupied with trying to generate cash and manage our cash flow. Sometimes we don't make enough money, and we're certainly not spending enough time working on the business to create those wealth producing systems. So here are some statistics for you. JP Morgan Foundation found that 75% of small businesses have less than 30 days cash on hand. And a quarter, I mean, there are 30 million businesses. A quarter of that, 7.5 million businesses, have less than 14 days of cash at the ready. I mean, they're one paycheck away from going out of business, and the lack of cash is a killer. 45% of owners claim financial illiteracy. They abdicate understanding their numbers to their CPA, who comes maybe, once a quarter and doesn't really understand your business, doesn't give you business consulting, he just presents those numbers, and they're a little bit static when you really need to be using your numbers to steer your business, to optimize your operations. And what does that mean? It means that the Small Business Administration say that 50% of businesses fail within their first 4 years. So if you're in your first 4 years of running a business and you're finding it challenging, you're not alone. And 80% fail within 7 years, and 90% fail within 10 years. So you toil away for a decade and you've got a 1 in 10 chance of still being in business. I don't want that to happen to you. What I want is for you to have a healthy business that you can run for as long as you want, that you have the freedom to be able to enjoy the fruits of ownership and maximize the value of your business, so that if you want to sell it to your employees, to your family, to an external investor, it's worth a lot of money. So we just have to keep our eye on cash. Little quote here. I work with one business owner, and he said, I mean, we're a big business. We're 20 odd million, but I never see any of the money. He says, God, I pay my suppliers, I pay my employees, and there's nothing left for me at the end. He said, the only benefit I get is the Amex points. And maybe some of you can relate to that. I mean, I shouldn't laugh, really. So yeah, moving on. So what are some of the things that, if you don't understand your numbers, what can happen? Well, look, there's treasure in your business, and it's guarded by dragons. All treasure is guarded by dragons, and the dragons that exist in your business that we need to slay are hidden costs that are eroding your profit. Money is leaving your business in the form of costs when it should be staying in the form of profit. Your balance sheet gets bloated, cash gets consumed, and it's very stodgy. And again, that cash should be in your pocket, it should be paying off debt, it shouldn't be in a bloated balance sheet. We'll talk a little bit more about that. And a lot of people, are growing their business. Well, when businesses grow, typically they need cash to grow. And if they're not designed well, they consume too much cash, or that cash is consumed in an unpredictable fashion. And number phobia, right? We don't understand our numbers, and we abdicate that. And I'm going to show you an easy way to understand your numbers, to identify where the dragons are, slay those dragons, and build a fantastic wealth producing asset. Come on, talk to me. All right, we'll move to camera B. Let's 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 see where we are with that. Okay. There we go. I'm back. Sorry about that. Technical difficulties. Got a little bit of a wiring problem, I think. Okay, well let's move forward. And what I'm going to show you is how you can actually understand the story of your business using your numbers to find the treasure in your business. So what I'm going to be able to do in the next 10 minutes is convert your numbers into an exciting story. Right? Because stories engage people. We understand things better in the form of story rather than in the form of numbers. And every story has characters in eternal conflict. And there are three characters I'm going to introduce to you that operate within your business. And then we've got two fundamental building blocks. And then every story has chapters. So there are 5 chapters to your business story. And so those building blocks and the story will help us reveal where hidden opportunity exists in your business. So those characters are vanity, sanity, and the king, as expressed in my phrase, revenue is vanity, profit is sanity, and cash is king. So vanity. All right. Now, a lot of, why do I say revenue is vanity? Often you ask people how big their business is, and they'll tell you, oh, it's 2 million or 3 million or 4 million. Well, how much money is it making? How much profit is it generating? How much cash does it flow? Right. So revenue is, I'm the growth guy. I believe in growth, but there's the wrong kind of growth and there's the right kind of growth. But vanity and your team vanity are the team that go out and sell and generate that revenue. And vanity is usually very bubbly and effervescent. And he feels that the only way to solve business problems is to sell, sell, sell. Right, that's team vanity. And then sanity is the guy who watches. He's all about the bottom line. He's black, he's all black and white, and he hates seeing red. And he's watching the margins. He's watching the gross margins. He's watching the price, and he's watching the costs. So when Vanity comes running in with a big deal, and Vanity's discounted to win that deal, poor old Sanity is pulling his hair out because he knows he's not going to make enough money to be able to operate the business successfully. Now, the third character is the one who has the most grandiose of titles, the king. He doesn't rule the empire, but he counts the cash. He keeps it in a big chest, and he counts it, and he lovingly protects it. The one thing about the king is he hates surprises, because if you have a sudden cash surprise, and you've got to pay a supplier, or you've got to pay a big bill, or you got to pay your employee. Remember those people who only had one paycheck, and a big deal doesn't go through, and the king hasn't got money in his coffers, and he gets surprised. Boom, that's a big problem. Now, the way that the Vanity and the Sanity and the king interact with each other is a metaphor for the income statement, the balance sheet, and the statement of cash flows, which are those arcane things that only CPAs understand. I don't want you to be thinking about those. I'm going to make it really simple for you. So I talked about the three characters. I've introduced those. Now let's talk about the building blocks. There are two building blocks: the money-making machine, which you will know as the income statement, and the wealth creation engine, which is the balance sheet. The balance sheet is a little trickier. All right, so I'm going to demystify the balance sheet for you. Most of you will understand how you make money. And here's an example, right? Follow the money, right? In the income statement, or the money-making machine, you go out and you get sales or revenue. And then if you're in a services business like flooring, roofing, HVAC, you've got to pay installers, you've got to pay for the materials, and you get gross profit. But then you've got to pay your sales commissions for people who made those sales. And then you've got to pay your other overhead costs, your salaries, and you get an operating profit. But you don't get to keep that profit. Your employees think you're making a lot of money, but you've got a lot of people to pay, right? You've got to pay the bank because you probably borrowed money to finance your trucks. You needed to finance big jobs because you had to get the materials in before they were paid, right? So you've got to pay the bank back the interest you own on debt. But you still don't get to keep that because now you've got to pay taxes. Uncle Sam wants it, so you've got to pay the government. And then the owners may take a distribution. That's the benefit of ownership. They get paid in the salaries and overhead. They take a salary for their working in the business, but they get a benefit of being an owner. So they want to take distributions. And if you've got debt in the business, you need to pay down some of that debt. And what's left at the bottom of the money-making machine is rocket fuel. It's really important because that rocket fuel is called equity. Retained earnings or equity. And we'll talk about that because that rocket fuel then goes into your wealth creation engine. And I'll give you a little example of a $8 million company, right? This is pretty average. $8 million in sales, $6 million in installation and materials, and they made $2 million gross profit. So their gross margin is 25%. My camera just went out again. Let's do this. Come on. There, we're going to go to a different camera and make it a little easier because that other camera is unreliable. So they pay usually 25% sales commission on 2 million. That's $500,000. They pay their salaries is about $1 million, and they've got a $400,000, operating profit or 5% margin, which is fairly typical. You'd like to learn more than that, and I can help you. If you're in the 3-4% operating margin range, I can get you up to 8, 9, 10% and help you grow your business by getting the right kind of revenue. They've got some interest to pay. There's some taxes to pay. The owners, there's two in this business. They both took $20,000 each, which is $40,000 in distributions. They decided to pay a little bit down of their debt of $200,000, which left them $30,000 of rocket fuel at the end. So when your employees are going, this is an $8 million business, these guys are creaming it, where do we see our share? What you get to take home is not for all of the risk that you take. So we want to be able to manage that risk effectively. Right, now let's talk about the second building block. The first building block was the income statement or the money making machine. The second one is the balance sheet, or I like to call it the wealth creation engine. And normally the way the accountants get it set up, the balance sheet is hinged, it balances, right? Balances between assets and liabilities. Is really, really difficult. It's not helpful. So I've rehinged the balance sheet and I've hinged it on funding, i.e. the money you need to operate the business, and the investments, what you put that money into to help you create the sales and the dynamic business. So in funding, there's only two places where your business can get money, and it comes either from your own money. That's called equity, right? Remember, you can put your own money in, write a check, or it comes from the money making machine. That bit at the bottom, retained earnings, the equity fuel, that's equity, that goes there. And then the rest comes from borrowing from other people. It's called debt. It's called other people's money, and it carries an interest. So that's funding, right? Now, we then use that funding to make investments. And for simplicity's sake, there are three types of investment you would make in your business. There's non-cash assets. So that might be your buildings, that might be your trucks, that might be your equipment, right? That's all of that goes there. And then there's working capital, which is the money required to operate the business. It's the money you need. It's called working capital. And working capital is simply your accounts receivable, which is you've done the work, right? You send out a bill, and you're waiting to receive that money. You don't have it yet. And it's a big problem trying to collect some of those accounts receivable. And sometimes it can take many, many, many days, 120 days to collect some of that money. That's a big problem. Plus your inventory, what you've got tied up in inventory, or underbilling. So if you're providing a service, you're doing a job, but you bill throughout the job. And if you've billed less, if you've billed less than the work you've done, you have underbillings, which is still money that's owed to you, but you haven't collected it. And you can take off what you owe your suppliers. That's a payable, which gives you your total working capital. And the reason for singling out working capital is it has a big daily effect on cash, and you need to watch cash in your business. So here's how it all works together. So we got our three characters, right? Vanity's going out making sales. He's brought the revenue in. Sanity's making sure it's priced properly. He's making sure that we keep our costs sensible. And then that money-making machine, it dribbles all the way down until at the bottom, it spits out that rocket fuel, that retained earnings. And that retained earnings is the equity fuel for your your wealth creation engine. It goes into that equity part. You can see it here, right? It's fueling your wealth creation engine. Now, if you're putting more fuel in the equity bucket, then you could actually reduce your debt, which would reduce your risk. But it also allows you to make further investment in the needs to be able to go out and sell. You might increase your working capital. You might increase your non-cash assets up there, which enables then Vanity to go and sell more. And that cycle goes round and round. And what you want is as an effective a money-making machine as possible. In other words, it's got to be effective. So the equity fuel dropping out of the bottom is as big as possible. And then you want an efficiency on the wealth creation engine. It needs to be a lean, mean balance sheet machine. It needs to have limited working capital, right? So that you can pay off that debt and have it really, really mean. And that will mean you generate lots of cash. So I hope all that made sense. I have a book on this, and I'm going to give you, in fact, let me pull that up here. So that you can get that. So if you go to mixfreebook.com. This whole methodology is highlighted in there with ideas on how you can optimize your business. So let's move on now to, we've got 3 characters, 2 building blocks, and now we're going to put them into a story, and a story of 5 easily understandable chapters. Chapter 1 is all about growth. How well are we growing? What's the quality of our growth? Is it good revenue, right? Are we turning that revenue into superior profitability? So chapter 2 is all about how much money we make from that revenue. How much of a gross margin do we make? And those 2 chapters are followed by our emphasis on working capital. We want a lean, mean balance sheet machine. And chapters 1, chapters 2, and chapters 3 all combine to give you the nirvana, cash flow excellence. You're generating positive cash flow. Now, if you have a problem with cash in your business, it's no good chasing cash, right? Trying to chase people for those bills. The seeds of cash destruction or cash consumption have been sown in chapters 1, 2, or 3 in the way that vanity, sanity, and the king operate. So you might have a chapter 1 problem, a chapter 2 problem, or a chapter 3 problem. And if I work with you, we'll identify which chapter is going to give you the most leverage. And what we can do then is take all of that information now and build your 1-page story. And what this chart shows, us is a prior period and a current period. So this could be a year or a quarter. So the prior period here, you can see there's 5 chapters that I just talked about. Chapter 1, quality of revenue growth, and that's based on year over year or month to month or quarter to quarter growth. In the previous period, the business grew nearly 10%, and in this period, the business grew nearly 20%. That's good. I'd give them a green for growth. The question is, did they turn it into superior profitability? Well, we've taken EBIT here, earnings before interest and tax. You can think about it as your operating margin, right? Well, it was 3% in the prior period. We'd like it to be above 5%, so I'm giving that a red. But it's moved up to about 4%. So I've done a good job in getting better pricing on the jobs, or we've managed our costs a little bit more effectively. Chapter 3 is working capital as a percentage of revenue. So I added up all of the working capital, receivables plus inventory minus payables to give my total working capital dollars, and I divided that into my revenue. So what this says, this 20.3 cents, is for every dollar of sale I make, I need 20 cents in working capital. So if I sell more, I need more working capital. And we'll see that that measure has gone from 20 cents to down to less than 20 cents. So the balance sheet has become less hungry. I call this the hunger measure. How hungry is the wealth creation engine for working capital? We want to drive that number down as possible so that we get it nice and lean. And those first 3 chapters combine to give us cash flow. And in the previous year, this business grew quite a bit, but didn't make much profitability, and so it actually consumed $2 million worth of cash. And this period it generated $500,000 of cash because we got our metrics in a better position. And then chapter 5 is ultimately the wealth we create in the business. You know, I said it's about growing your business, making money, generating cash, and building wealth. The wealth metric is return ROCE, return on capital employed, which is which is the effectiveness of your money-making machine, which is EBIT, earnings before interest and tax, divided by the efficiency of your balance sheet, which is net operating assets. And you can see that for every dollar I have invested in my business, I got a 13% return last year. This year, I'm doing much, much better. I got a 23% return. So in just a few minutes, if you just gave me those four numbers, right, for this period last year and then the current period, I could diagnose whether you have a chapter one, a chapter two, or a chapter three problem. And I can tell you where the opportunity is for growth, for profitability, and for cash flow by using this simple method. So hopefully that illuminates how your numbers work, how the characters and teams within your business relate and deliver those numbers. And now we've got a method for diagnosing those numbers. So in summary, revenue is vanity, profit is sanity, cash is always king. We want to make sure that you have predictable cash flow. If you're getting angst about cash, it's unpredictable, then I know how we can diagnose and find that. We can optimize your profit. Generally, if we look at your portfolio, there'll be areas where you're making a ton more margin, a ton more gross margin, and we need to be doing more work in those areas. And that then allows Vanity to go and find the clients that deliver that high profit, faster paying work. A little bit of portfolio analysis attached to this will show you how you can dramatically improve your business. And we turn that into a story of 5 chapters. And this is detailed, in more depth. And it's free, a free book, mixfreebook.com. Just go do that, and that will add to the presentation that I've just given. So let me just check the chat here and see what was happening. Oh yeah, there was one question why I spent a little bit of time emphasizing cash. Look, cash is the only true number. Revenue can and profit are accounting numbers. You can't spend revenue, you can't spend profit, you can only spend cash. Right? You got bills to pay, you need to pay in cash. If your business is not generating cash consistently and you're not forecasting it, the king gets very, very unhappy. He's run out of cash. All of a sudden you've grown. You now need to finance some more of these jobs. You need an extra $100,000 in cash flow and your coffers are empty. The king wasn't inspecting it. Then the king and you go to the bank and say to the bank manager, hey, we need another $100,000 in cash. And they look at your business and go, well, that's a bit risky. We're not lending it to you. Boom. You can be out of business in a heartbeat, or you've got to go to some very, very expensive lending sources, increasing your risk and increasing your stress in the business. We don't want that. So I hope you enjoyed this week's show. I'll be here every week at 1 o'clock Eastern time. If you have questions, you can also reach me. I'll tell you where you can reach me. And there we go. You can schedule a call with me at speaktomick.com. We can talk about your numbers. We can easily put together your business story, and I'll tell you exactly where opportunity exists in your business. Until then, I'll see you next time.